Hi, I'm Patu from freefincal, and today let's talk about one of the most important aspects of portfolio management. Do you have the courage to buy an asset class like gold or equity when it is not doing well and sell the asset class when it is doing well? I'll explain what it means. Today you see, if you go to the newspaper, you would see many people tell you should go ask you, should gold be part of your portfolio? Are you buying gold? Why is gold moving up, and so on? You see all these kind of articles there. This is the price of gold per gram in INR. You can see it started around 1000 in January 2008 and zoomed up to 3500, not in a nice linear way, but it has moved up. Now, if you look at this region between 2010, 2011, 2012, you would have got the same kind of articles. Those who were following personal finance at that time, they would have got articles like, should gold be part of your portfolio, how to invest in gold for your child's marriage using ETFs, gold funds, because that was the time the AMCs were busy launching gold funds and ETFs, and they were pushing articles, planting articles in media. They were paying for it, or they were doing it via their distributors, and they were very busy asking people to buy gold because at that time gold was zooming up. Then gold crashed, and between 2013 and 2008, nothing. It was completely sideways. It was going down, and then it did nothing for 5 years. Zero returns for somebody who was invested at this point here. Nothing. No returns from gold at all. During that period, nobody talked about gold. And then today, again, when gold has picked up in the last few months, everybody is saying, should gold be part of your portfolio? Are you selling your equity mutual funds and so on? This is how the media works, and this is how investors work. Today, they want to know, should gold not be part of the portfolio? Well, you dumbass, gold should have been part of. If you think gold should have been part of your portfolio, you should have had the courage to invest in it here. Nobody has that courage. Nobody talks about buying an asset class when it is not performing. That's when they should be buying it. A market linked asset class will have cycles, it will go up and down. When it is not performing, that's when you buy it. When it is performing, don't talk about buying it. That's the opportunity has already gone past you. I mean, I am not talking, first of all, let me make it clear. I am not talking about buying gold. I am not saying you should buy gold. No, gold is unproductive as an asset class. There's no need for gold in your portfolio. I want to make it clear. But I just want to explain why and why people have this bad idea of wanting to buy an asset class after it has started moving up. And that's just, in my opinion, too late and wrong as a strategy also. So that's the first point. The second point is, let's have a look at gold and the Nifty. So this is what I've done here is I have normalized the graph on as on 11th January 2008, and then I have taken the logarithm, the log 10 of the price, and that's why you see in a slightly weird way, you can see it start from 0. The graph will start at, the price will start at 1, so log 10 of 1 is 0, so that starts at 0 and then it kind of moves up. And even so, for somebody who's just started with some allocation of gold, let's say 20%, 10%, whatever, some allocation, as some people say, whatever that nonsense is. For somebody without tracking the market, they would have simply, they have just started investing in both Nifty and gold, SIP, lump sum, however way you invest, doesn't matter. They would have seen that around this 2010, 11, 12 period, gold would have moved up. They would have got nice returns in gold, and at that time, they should have shifted, booked some profit in gold and shifted it to equity, which was not performing. That's what I'm trying to say here. Book profit or sell an asset class which is doing well and shift it to an asset class which is not doing well. Then a few years later, equity would have done well. Gold would have been in the doldrums, not doing well. Shift book profit from an asset class which is doing well in this period and shift it to an asset class which is not doing well. Again, back again here, book some profit to an asset class in this period, book some profit from an asset class which is doing well, which is equity, and shift it to gold which is not doing well. If you did that simple, without looking at news, without tracking anything, without looking at any technical indicators, if you just did this, you would have reduced risk in your portfolio. For those people who think gold should be part of the portfolio, don't say gold should be part of the portfolio after you see it move up for the last few months. That is not correct. If you want gold to be part of the portfolio, you must be ready to face that 5 years of no returns. So 5 years of sideways market. You should have had the courage to buy gold when it was not performing. People don't have all that courage. They talk a lot. They don't want to pay taxes. They only want an asset class which is offering returns. They will look at the last couple of year returns, assume it will happen in the next 2 years, and then buy that. That's just complete nonsense. So you should have this courage to buy an asset class which is not performing by shifting profits from an asset class which is performing well. This simple portfolio rebalancing idea is enough to create a lot of wealth with minimal risk. If you over a period of time, it doesn't matter which gives you this return, that return. If you keep investing regularly, increase your investment regularly in a set portfolio with a specific asset allocation, you can do this. If you want to add gold, go ahead and add gold, but be prepared to face consequences. But I don't recommend it. There's no need for it, in my opinion. Finally, if you look at this graph, people may say if I had invested in gold on January 11th, 2008, I would have got more returns today than Nifty. That is true. That's about 11.6 year period. That is true, but don't make assumptions based on that. See, for example, if you look at 2,306 11-year data points of gold and Nifty total returns, that is including dividends. The gold is the yellow line and the pink is the Nifty. You can see that it doesn't matter. Sometimes gold has done well, sometimes Nifty has done well. You don't know. And people say there is an anti-correlation. If gold does well, then stock will not do well. If stocks does well, gold will not do well. That is seen here, but that is not seen for the last few years. Both of them are going down. So you can't make such generalized comments and get away with it. Again, this is over 12 years. Again, this is over, this is what you saw earlier was 11 years. Now this is over 12 years. And again, you can see sometimes it does well, sometimes equity has bet gold over 12 years, sometimes it does not. But okay, so you can say, you can ask, does this not mean I should have gold in my portfolio? Go ahead and have it. How much will you have? 10%, 20%? What difference will it make? Do you have the courage to have 60% of gold in your portfolio? No, most people won't, because they are worried about taxes, they are worried about risk, because not only is there risk of the gold price fluctuation, there is risk of forex also. So, I mean, if you look at truly long-term returns, equity has generally done well, so there's always that fear in the back of the mind that they are missing out that opportunity. So most people will not have enough of gold, and there's no need for it. But my point here is that you should have whatever your belief, whether you believe in gold or not. If you want to invest in gold, then invest in it when it is down. Have the courage to invest in it when it's down by booking profit from your equity investments which are doing well, and vice versa. If you don't have that courage, there's no point talking about portfolio management, asset allocation, all that. It's just nonsense. You're just not having a strategy. You're just reacting to news. So that's what I wanted to say in this video. I'll catch you again later. Bye-bye.